Invitado es Marco Meijer, portfolio manager de renta fija para MIFL, para Mediolanum. Marco, good morning.
Good morning. Buenos días.
Buenos días. 2022 has been a very difficult year for fixed income, and the growth outlook for next year is not great. Yet, Mediolanum is constructed on fixed income. Why?
Yes. 2022 has been a very tough year for many asset classes, but for fixed income in particular. Investors would consider bonds a safe asset, but they have performed as poorly as the S&P. Major bond market indices are down 15% or more. And there's been no hiding from this dramatic rise in inflation. Even gold is down this year, and also inflation-linked bonds that are meant to protect. But central banks are acting, and they have moved rates up aggressively, and now in what is called restrictive territory. That is the point at which it slows down the economy and then also inflation, hopefully. This week, the Fed, the ECB, the Bank of England, the Swiss National Bank all raised rates by 50 basis points, and they signaled that there is more to come. So the difference between now and a year ago is that bond yields are high enough that they are likely to generate positive returns. Even if yields continue to rise a little more, which is a possibility, say if inflation doesn't come down fast enough.
Inflation appears to have peaked both in Europe and the US, but you mentioned the risk that inflation won't come down fast enough. How does that impact your outlook for fixed income?
Yeah, inflation will come down a lot, we think, and growth will slow, but we don't expect a deep recession. Now, that is a scenario that is good for high-grade bond markets, investment-grade corporates, as well as sovereign bonds. But weaker growth is not particularly good for equities and the higher-yielding corporate bond market. So the key risk is indeed that inflation doesn't slow down fast enough, in which case central banks have no choice but to push the economy into recession. But this will invert curves, meaning it will benefit longer-dated bonds. We think that there is relative safety in the longest-dated bonds compared to short or medium ones. So, for example, we own some 100-year Austria, which is an ultra-long bond. We are cautious on countries that have high debt burdens, where sticky inflation could bring up questions of debt sustainability back into play, which you haven't seen for a while. Now, if on the other hand, inflation does fall fast towards target, then the whole curve will rally. You'll do well in short bonds and in longer-dated bonds. But we think the longer-dated bonds at this point in time offer the best risk-reward.
Do you see central bank policy for next year as supportive for bond investor, or is it the opposite?
Yeah, that's a good question. I think we must remember that central banks don't serve the market. They serve consumers ultimately by controlling inflation. And yesterday, the ECB announced that they will start unwinding quantitative easing by 15 billion a month, starting in spring. This is also a form of tightening of policy, right? So not reinvesting all the bonds that are maturing that they have on their balance sheet. But it also means that they don't have to hike rates as much because the two are complements to each other. But what is also important to remember is that central banks provide a backstop to combating systemic risks, like the Bank of England did last October when they had to intervene to calm down the gilt market. And the same exists in Europe. So even if such support, emergency support, is never activated, the knowledge that we know it is there, it reduces the tail risk, the credit risk premium that is required for countries with high debt burdens. But this only works, this backstop, if problems are not self-inflicted, such as political missteps or fiscally imprudent policies. But we don't see that at the moment. So we think sentiment towards European sovereign bonds in particular will improve over the coming year.
And Marco, which part of the fixed income world do you think offer the best risk reward, and what's the best strategy to allocate to fixed income?
Yeah, I already suggested that the long end of the sovereign market is appealing. For example, 30 years Spanish bonos, they yield 3.5% at the moment, whereas the ECB inflation target is 2%, which I think is still credible in the long run. So you get an extra 1.5% on top of this long-term inflation, a positive real yield. Now, it may be that 3.5 is not the top. We may drift back to 4% yield, i.e. bond prices go down a bit. But I still think it's attractive to already start investing a bit now and then scale in a bit as the year progresses. So don't put in everything in one go. Now, because of the risk of this sticky inflation, despite an economic slowdown, corporate debt is still quite challenging, particularly the higher yield end of the corporate debt spectrum. We would therefore think it is premature to allocate too much to corporate bonds, particularly those higher yielded ones. But we think that many emerging markets, particularly countries that have been quick to raise interest rates to combat inflation and are now at the end of the cycle and may even start to reduce rates next year, that those look attractive. I'm thinking Brazil, Mexico, highly rated emerging markets that have plenty of room to support their economies if required. So, but you have to be very selective in those countries, and this is what we do here at Mediolanum with great care. And I think 2023 is going to see a decent reversal of the negative returns that we saw last year. 2023 is going to be a better year for fixed income overall. Thank you.
Marco, thank you for this time. Thank you for joining us on Negocios Televisión. Marco Meijer, portfolio manager de renta fijada para Mediolanum, para MIFL. Thank you.
Take care. Bye bye.
Y nosotros